Hello everyone and welcome back to the channel. In today's video, we're going to take a closer look at Google and break down my thesis on why I believe the company is still undervalued despite its recent performance. After that, we'll shift gears and review the latest market news, focusing on what's ahead in September. In particular, we'll discuss how the renewed Trump tariffs and the upcoming U.S. jobs report from the Federal Reserve could shape market sentiment and influence trading in the weeks ahead. Alphabet represents a strong bull case. While the market is highly focused on the regulatory and AI competition headwinds the company is facing, it may be mispricing the giant. This may be due to overlooking the company's options for monetizing its AI models, the growth of Google Cloud, and the strength of its search and YouTube businesses. The company currently trades at a price-to-earnings multiple of approximately 20x, which offers a discount compared to both the S&P and its peers. Furthermore, Google's reputation for lagging in the AI race may not be deserved due to the company's success with monetizing its AI features and driving user engagement. It is easy to view Alphabet as a series of siloed businesses, but this fails to appreciate the true competitive strength that lies in its deeply connected ecosystem. The key to this system is the self-reinforcing flywheel that these segments of the business create. While Alphabet is involved in many different markets and ventures, Google Services remains the engine of the company. This segment includes Search, YouTube, Android, Chrome, Maps, and the Play Store. Not surprisingly, this critical part of the company generates substantial revenue and operating income, with these figures topping $220 billion in 2024. Furthermore, this is a high-margin segment that regularly posts operating margins above 35%. These services are also the core of Alphabet's massive user base. The company has 15 products that serve 500 million users. 6 of these products, including Search, Android, YouTube, and Gmail, serve over 2 billion users each. This reach provides Alphabet with unique advantages when it comes to its AI ambitions. For example, the size of Alphabet's infrastructure makes distributing new features cost less while offering cross-selling opportunities. A challenge for companies of Alphabet's size can be finding new growth opportunities. For Alphabet, Google Cloud has become a critical source of growth. This segment of the business's operations has achieved an annual revenue run rate of over $50 billion, and it is growing at an impressive 32% year-over-year rate. Google Cloud has also become sustainably profitable as it posted $2.8 billion in operating income for the first quarter of 2025. The company's Other Bets segment acts as an internal venture capital fund that is strategically used to pursue high-risk but high-reward ventures. This portion of the company is currently generating losses that amount to over $1 billion per quarter. However, these investments represent Alphabet's entry into developing markets that have high potential. A perfect example of this is the company's position in Waymo, the autonomous taxi company. Despite being high risk, these ventures represent tremendous future growth potential for the company that is difficult for markets to effectively price into the company's value. The company's research and development segment is responsible for many critical assets. DeepMind is an example of this, as it is the lab responsible for creating Google's Gemini models. This division also acts as a crucial hub for research whose costs are absorbed by the company as a whole, but whose innovations power many of the other segments of Alphabet. When evaluating Alphabet, it is beneficial to avoid making the mistake of viewing the various segments of the company as individual parts. In reality, these various segments work to reinforce each other, which offers Alphabet a powerful advantage. More specifically, this flywheel is composed of Alphabet's data, AI, and distribution infrastructure. Google Services plays several roles in its strategy. It acts both as a data collection and distribution system for the company's AI products. This data acts as a valuable source of training data for the AI models, which provides Alphabet with a quantity and quality of data that most AI companies do not possess. These improved models are then integrated into the Google Services ecosystem, which boosts the value of the products under this umbrella. Lastly, the AI products and infrastructure are packaged and licensed to enterprise clients through Google Cloud. The unique interplay of this flywheel is a powerful competitive advantage that can also be easy to underestimate. Concerns have been raised that AI could potentially cannibalize Alphabet's primary revenue streams. Yet, the company's recent performance contradicts the cannibalization concerns. Data from Alphabet's first half of 2025 showcases the resilience of the company's core businesses, along with the effectiveness of its long-term AI monetization strategy. Search and related services showed accelerating strength by posting 12% year-over-year growth during the second quarter. This was an increase from the 10% growth during the first quarter. In another example of the company's self-reinforcing flywheel model, its AI overviews are proving to be highly effective. They are currently used by billions of people a month, and they add to overall search usage. Furthermore, they are monetizing at rates that are similar to traditional search. As a result, the idea of them replacing search behavior is weakening in favor of them adding to user engagement. Google Cloud is further solidifying its position as a key enabler of the company's efforts to capture a share of the enterprise AI market. This segment's 32% growth in the second quarter is a reminder of this segment's potential. The number of deals that the company secured with large-scale enterprise clients has surged, as the total value of these deals for the first half of 2025 has already exceeded the total for all of 2024. As an example of the scale of these deals, Alphabet recently secured a $10 billion deal with Meta. A strong signal of management's confidence is the recent revision of its capital expenditure forecast, which was increased to $85 billion. This investment is a long-term offensive investment in the company that is partially in response to increasing customer demand. Much of this will be dedicated to building data centers and other infrastructure to support the substantial technical demands large commercialized AI models require. While these expenditures are substantial, they will help to support the company's strategy for years as it continues to develop more powerful AI products. Alphabet's flywheel strategy for competing in the emerging AI market requires immense resources for building data centers, acquiring GPUs and TPUs, along with competing for world-class talent. To this end, Alphabet's profitability and strong balance sheets are essential components for supporting the company's AI strategy. Alphabet's AI flywheel has been costly to build, and it still requires constant large investments into research and development through Google DeepMind in order to remain competitive. Fortunately, Alphabet's core business has remained extremely strong, with it generating over $115 billion in net income during the trailing 12 months. In addition to generating cash, the company is also extremely effective in terms of margin and return on equity. For net income margin, the company has a healthy 31.112% and a return on equity of 34.83%. These healthy numbers show that Alphabet has ample resources for supporting its crucial AI flywheel strategy. While Alphabet found some early success in its AI strategy, the market is still competitive, and the company has yet to meaningfully distance itself from its competitors. This will require the company to sustain its current capital expenditures into AI until it has created a long-term competitive moat. As a result, its fortress balance sheet becomes even more valuable to the company. This stability rests on the company's $95.32 billion in total cash and its low total debt-to-equity ratio of 11.48%. As a result, the company enjoys a comfortable cushion and strategic flexibility without having to significantly limit funding to segments of its flywheel. The ability to sustain investing in its core operations while pursuing the rapidly developing AI market is a critical strength that helps to support a bullish outlook for the company. A discounted cash flow analysis is one way to value Alphabet stock, and this analysis shows that the stock may have an intrinsic value of approximately $238. Much of this rests on the premise that Alphabet's investments in AI will help to drive accelerating growth, along with expanding profitability over the company's long term. In order to utilize a DCF model, there are several key assumptions that must be made. In the case of Alphabet, starting with a growth rate of 13% in 2025 and accelerating to 15% by 2027, seems reasonable given the company's recent performance and the monetization prospects AI offers. Furthermore, this model assumes improving efficiencies and a richer product mix, leading to the EBIT margin increasing from 33.16% to 35.16% by 2027. CapEx is another important attribute for this model, but this is a slightly complex topic given Alphabet's massive expenditures on AI infrastructure. For the model, an assumption of CapEx normalizing to 9% of revenue is used, which is reasonable given the company's 5-year average of 11.80%. Weighted average cost of capital is another key value in the model. 8.2% is a reasonable assumption for this variable, as it reflects the likelihood of Alphabet successfully executing its AI strategy. Terminal growth is another key consideration that reflects the amount the company will generate beyond the model's timeframe. For a company of Alphabet's size and reach, a terminal growth rate of 4.0% is reasonable, as it is above inflation, while still representing the intense competition that Alphabet could face as the AI market continues to mature. These calculations suggest a bullish future for Alphabet with substantial upside. However, a key assumption of this projection is the revenue growth and expanding margins, which will require the company's AI strategy to be successful. Alphabet's size and influence across a range of markets make it a common target for regulatory scrutiny. This has reached new heights as the company is currently facing antitrust scrutiny in both the US and Europe. In the US, the legal action is primarily targeting the company's search monopoly. However, Europe is targeting its ad tech, which has preliminarily been ruled in non-compliance with the Digital Markets Act. The risks from these legal threats range from a breakup of the company to hefty fines and other punitive actions against the company. While Alphabet is investing heavily in AI, it should be noted that AI has the potential to disrupt Alphabet's key search and advertising businesses. In particular, AI-native search engines could fundamentally alter how users interact with these services. This could put Alphabet on the defensive, requiring it to dramatically change one of its core pillars. An example of this could be the inclusion of AI overviews into search results. These overviews increase user engagement, but they reduce the click-through rate for websites. Google Cloud's impressive growth makes it an important part of Alphabet's future. However, it remains third in market share within cloud computing, with Amazon and Microsoft leading. In its efforts to gain market share, Alphabet does benefit from the fact that Google Cloud is growing faster than its rivals, but it requires ongoing investments in order to close this gap. As a result, an execution failure in this segment could pose a risk for Alphabet's AI plans and growth opportunities. The evidence strongly indicates that Alphabet's stock is trading at a discount relative to its intrinsic value. The company's flywheel structure for developing and distributing its AI products, along with its strong financials, gives it the resources to continue growing. This has been evidenced by the success of Google Cloud and its Gemini models. Together, these factors make Alphabet a buying opportunity with a potential price target of $238. Now let's have a look at the coming jobs report. The article highlights growing investor focus on the U.S. non-farm payrolls report for August as a critical indicator ahead of the Federal Reserve's September meeting. The weaker than expected July jobs number, just 73,000 additions, and significant downward revisions in previous months have elevated expectations for a rate cut in mid-September. Markets are now speculating that the Fed's decision largely depends on whether labor market resilience continues or deteriorates further. What's the August non-farm payrolls report is viewed as a crucial final test for the Federal Reserve's September 16 to 17 meeting. July's disappointing data: only 73,000 jobs were added in July, with previous months revised sharply downward by reflecting just 35,000 average jobs per month for May-July. Jerome Powell has hinted at a potential September cut, though it remains conditional on the incoming jobs data. Analysts and investors are interpreting this report as decisive. Soft figures could further tilt expectations toward a cut. Stronger than expected data may delay or limit easing. Trump's tariff drama continues. The Trump administration's tariffs have been under legal fire for months, and last Friday, the U.S. Court of Appeals ruled against them, supporting a lower court decision. The White House has until mid-October to take it to the Supreme Court. Analysts call the decision neutral for markets. It doesn't remove the tariffs, but adds a layer of uncertainty for companies. Expect more back and forth as the administration seeks stronger legal footing for its trade policy. That's all for today. Thanks for watching. See you in the next one.